Welcome to Chapter 2 of our tax course, again with your professor, Nathan Aragon. In this chapter, we're going to focus on basically the first part of the tax return that deals with gross income and exclusions on 1040. We're going to look into what makes up the income process and the certain exclusions that are not considered income. We're also going to have a few calculations going on here, and overall we're going to be seeing what makes up that first part. Now I will reference the book when the PowerPoint actually references a table or anything like that, so I will pop up the ebook a few times to show you where you can see this information in the ebook, okay, or in your textbook. Now, with this, we do have our learning objectives. These learning objectives that we do want to kind of get an understanding for is one, defining gross income. What is it? Describing salaries and wage reporting. General tax treatments for health insurance. Calculate taxable portions of annuity. Identify exclusions of gross income. Identify common employee fringe benefits. Determine municipal bonds, interest tax treatments. Explain tax implications when it's to the education saving vehicles. Describe tax treatments of unemployment compensation. Again, apply the rules governing Social Security payments, which is, that one's a fun one. And distinguish between different rules for married taxpayers residing in community property states, which is basically our state. Our state is a community property. So starting off, what is gross income? Gross income is basically all income for whatever source divides that we receive. And it's a long list. In fact, it referenced two tables right here that you can go find on your ebook. So let's go to our ebook. Here it is, Chapter 2. So if you don't know how to get to this, you can actually go all the way to your ebook, which is basically under your source, study guides and source. When you go to your ebook, it will actually list up all the chapters, and we can just find Chapter 2. And basically you can go to the course introduction overview. Here is table 2.1. So with table 2.1, if you hit that plus sign, you get this enlarged view. All of these are inclusions to gross income, and still this is a partial list. Gross income, again, is really any income, any money that we receive, minus a few exclusions. So as you can see here, amounts recovered after being deducted in prior years. We got awards, bonuses, clergy has their fees and contributions, commissions, debt forgiveness, dividends, embezzled funds. Yes, report anything that's an income. So even fraudulent stuff you report as income. Basically still helps you out with the IRS. IRS just wants their share. So as you can see, even gains from illegal activities on here. Gambling winnings, hobby income, jury duty fees. The list is huge. So again, the rule of thumb, if it's an income to you that does not include any exclusions, basically if it's income to you, you may want to report it. Likewise, there is exclusions. So here, a few of these we are going to actually get into, but as you can see, the list is a lot shorter than the gross income that actually is included. But some of these include accident insurance proceeds, alimony under certain conditions, which of course alimony is going away for I think for 2018. Bequeaths, casualty insurance proceeds, child support, again, damages from physical personal injuries, gifts to a certain point, group term life insurance premiums paid by the employer, health insurance proceeds, inheritances, mills enlarging due to furnishing for employees' convenience, Olympic medals. So if you decide to go into Olympics, you don't have to include that in your gross income. Yay! No paying taxes for representing the country. Booyah! Social Security benefits within their limits. Scholarships, that's a big one. And there's a few. You can definitely read this list. And so we do have a lot of income that's included on our tax return. We have some that get to be excluded. Do we want to at least have that traceability in case IRS says, hey, you might want to include that? And you can go, well, no, it's part of exclusions. Here it is. It's part of this. So those are good two lists to actually look over and just understand what's included and what is not. So other items that can be included as sources of income are non-cash items, so included in a fair market value, and barter transactions are includable. So if I trade chickens and cows, well, I better know my price for the cows I received, or I did a service and they paid me in fish. I gotta know the cost of that fish. Now, this is happening right now. The IRS now requires that wages paid using virtual currency, such as Bitcoin, have to issue what is known as a W-2. Now, W-2s are all dealing with salaries and wages. In fact, most of us should actually receive a W-2 if we're working for someone else, for some business. If you work on your own, you get the other one, which is the 1099 miscellaneous. Those we'll get into later on as we progress. But 83% of all tax returns filed include some kind of wages or salary. Almost 70%, this is probably all they have is W-2s. They don't have anything special. But we actually do have to understand the W-2. How does it file? What does the information tell us? What's cool, we do have software that helps out, but having that basic knowledge really does help us out. First one is basically box number 1. And I'll tell you, documents are pretty simple in how they work. They will actually label. So box 1 is wages, salaries, and tips, which is found on 1040. And on the form 1040, it's usually line number 1 of your gross income. What is your wages, salaries, and tips? Box 2 is going to report the federal income tax withheld. Box 3 through 6 shows Social Security, Medicare, and any other taxes. Sometimes the state will have a tax that gets pulled out of your wages. Box 8 reports any allocated tips if you're in as a waiter or anything like that. Waiter or waitress, or receive tips in either form. And box 12 is probably the most interesting one. The box 12 shows so much different forms of compensation, and knowing these codes actually helps out. But you have code C, which of course is a taxable group life insurance. Codes D, E, and G are deferrals into retirement plans. Code V, non-statutory stock options. Code WW contributes to an HSA. And code DD is cost of employer provided health care. Most likely the codes that you're going to see more often is probably code DD, And let's just say that's a cafeteria plan. Okay, employer provided health care, especially with the big companies, especially since that was part of Obamacare that said that they had to, that employers had to, if they're so big. So you usually will see a code-DD. So for example, here's our W-2. So again, you have to put the identification. So you got to put the social security number. You have to put the EIN number of the company, which is again their employer identification number, so that the IRS can trace back to the right company. The employer's information has to go here. The employee information goes here, and then here it is. So their wages, tips, and other compensation for 2018 was $130,627, with a portion of that going to federal income tax of $15,184. Their Social Security wages tapped out. Now, since this really isn't a payroll course, in payroll you'll get more with the W-2. This is more crash course and payroll, but the payroll tax course gets more involved with W-2s. But this Social Security does have a limit of how much they can actually take out or how much they use of gross wages. But Medicare does not. So Social Security is $128,400. That's the max gross income that they can take their numbers from. So this is usually going to be the max Social Security that you're going to see. So $7,960.80. Medicare is more than our wages. Most likely that is due to health insurance. So $137,627, and we end up paying Medicare tax of $1,995.59. So this is our wages. These are all the deductions that came out, and then 12 has a few more deductions. So with that, of course, we see our letters to identify how much money was actually used. And we also have our dependent care benefits, number 10. That's a new one. That's usually for child care. If the employer provides child care, you got dependent care benefits. Now, one of those fringe benefits that we get to see. We also see on 13, retirement plan is checked, just to show that there is a retirement plan, IRS, pension, whatever that is. Here we see that their state IN or Indiana. So they're in Indiana, and Indiana apparently has a state income tax. So they're also showing how much state income tax was taken out. And again, how much local income tax. Oh, they have local and state. Ouch. Here in the state of Texas, we don't have to worry about those two. Yay. But this is what makes up more that has been deducted from their wages. Again, all those will have certain calculations, certain percentage, depending on basically the certain rules for the state. Social Security and Medicare are typically the same. They're going to be a little bit over like 6% or something for Social Security. Medicare makes up the rest. But again, that's more payroll tax. Once we get into that, you get to see that. All I want you to know is be familiar what the W-2 is, how does it look, how do it mean, basic understanding of the W-2 itself. Now, one of the things that is excluded that we're getting into, so this is our main culprit on gross income. Again, there's a lot more that we'll get into as the course provides, but we're going to also be dealing with these exclusions. Accident and health insurance premiums. taxpayers can exclude any income from the total amount received for payment of medical care and payment for loss of a body member or function. Mostly both of these pop up into Schedule A. Now, with this, if we do get proceeds for an accident from an insurance company, we do not have to declare that income. That is excluded. Now, premiums paid by an employer on an employee's behalf are also excluded from income. So, and that includes for medical insurance or for accidental death and dismemberment. We do at times have to provide if it's an HSA, which is another health savings. If we have one of those health stuff we do, because that's a savings plan. But if it's anything dealing with the insurance premiums, we can exclude from, which is awesome. We love that. Also, we have meals and lodging. Basically hotels, stuff like that, cabin, if we get the cool cabin. Meals and lodging provided by employer are generally excluded from income, only if these two tests happen. If these two tests do not happen, then we actually have to include income for us for meals and lodging. 1. Meals provided by employer are on premises during work hours. They are solely for the benefit of the employer. So those can basically be excluded, be deducted, so forth and so on, if that's the case. So if you're running your own business, if you do this, it's a deduction for you. But the employee must be available for emergency calls or is limited to short meal periods. It's the only reason why they provide this benefit. Now, this one is also, we're only allowed to deduct 50% of the costs by the employer. So the employer can only deduct 50%. So no matter what, I mean, if you want to be a good boss and you want to provide the donuts and you want to provide certain things, then that's a good one. You can deduct the meals. If you're a Schedule C independent contractor and you got the 1099 and you have to have a meal during your working hours, again, you can have the possibility of deduction. Again, meals and entertainment, this is another term for this, is one that the IRS watches out. So if you have a question to deduct one, probably want to get a hold of another accountant to help out. But for us, if you actually provide for your employee, or you personally had to go buy meals during, like, you had a big job and you had to go take your client out or something like that, you can only deduct 50%. Okay? Lodging, those tests, if lodging provided by the employer on premises, it must be accepted as a requirement for employment. So, certain places you have to stay there. You actually have to live there for a little while. And if that does happen, it has to be a requirement for employment. So for travel agents, ones that traveling salespeople, they have to pay for hotels. Well, that's part of a requirement of employment because they're a sales agent. They can deduct that. It's excluded if they are provided that income. It's like the employer actually pays for it. Well, we get a little help from that, and that's excluded. Alright, so now we're getting more into fringe benefits. Fringe benefits are basically more so benefits that are applied to you for the job you take. These are special little incentives to have this job that the employer takes care of you. Well, one is actually called flexible spending accounts. These flexible spending accounts are roughly close to also health spending accounts, HSAs, and they're employer-sponsored plans. These allow employees to set aside pre-tax dollars. And when we talk about pre-tax, this actually is basically taken out of your gross income before federal, Social Security, and Medicare is taken out, which is great. It actually saves you a little bit on taxes, and it's a good benefit. Dependent care flexible spending accounts are basically only up to $5,000 a year. So with that, again, that can be used for your child care, the daycare that you actually have. If you have to have an in-home nurse while you're gone for a parent, it helps provide a little bit of that. And you'll see that again on box 10, just like our example before. Healthcare FSAs are basically up to $2,650 per year. So again, the employer can only put that amount in, and they are basically still have copays in Medicare. They help provide for those. They help provide also for dental work, optical care, prescription costs. So anything related to your medical needs. Again, you only get about $2,650. Public transportation, parking, commuting, biking, that's pretty cool. Costs, they're up to certain limits. And again, these all help with tax savings because they're coming out before the actual taxes. So when we look at the wages, the difference right here is probably making up a little bit of this $5,000. So we would add that $5,000, probably have another $2,000 running around somewhere, but basically it's coming out of here before this amount gets taxed by these three big ones. Okay, so back to this. So, but they also have a use it or lose it provision. If any amounts are left in the FSA after a certain date, employees loses them. So it makes it more of an incentive to basically use your amounts, which dealing with healthcare is probably going to tell you to go get that dental checkup, go get the eye checkup if there's anything that you need, stuff like that. I mean, always check the contract that you receive that will state about FSAs and see if they need what the dates are. Now, you can carry over up to 500 of an unused amount into a 3-month grace period into the next year, because usually FSAs, even if there's not a certain date, tend to be at the end of the year. So 500 is actually pretty good if you still have that unused. If you have more than 500 that you didn't use, well, you just lost out of that money. Okay, so into a 3-month grace period, so just in case something happens. I'm honestly saying these are good benefits. They're excellent benefits to have just in case the worst happens. Other fringe benefits from gross income, you can look at employer paid premiums for group term life insurance with the face value up to $50,000. So employer can actually pay for life insurance. This mostly happens with a lot more what we say government employees. So teachers, police officers, so forth tend to have more life insurance in their contracts, but any employer can actually do this. It's again a good benefit. We may have education assistance plans. This is only up to $5,250, but again, that can help out. Especially, I mean, if you work like, I know Taco Bell and Walmart very much are big on this part because they want to get their workforce educated, because they like to hire within a lot of times. You got the qualified employee discounts with exceptions. So again, another benefit that the employer can offer. Working condition fringe benefits, only excludable if you could deduct the item on your own as an employee. Okay, the minimus fringe benefits, basically immaterial stuff that's not even worth tracking, so don't even worry about those. Tuition reduction for undergrad and available to all employees, so that cannot be specific. Value of memberships to on-site athletic facilities, retirement plan services, which is nice. Again, if you can get into a retirement plan, IRA, Roth, whatever, get into it as quickly as you can. So, other excluded fringes that we have is on table 2.3 on page 2-12. So let's go find 2-12. So, next page. See, there's our salaries and wages. Here's our healthcare. So again, it's always good to read. And I will tell you this, cool thing with the ebook is you have more examples that happen, and then it also gives you self-study problems. So you can actually put an answer in and you can see the solution. So I will always do the answer first and then see if you're correct. If you're not, you want to go back and check it out. Okay? And again, we'll get into chapter 5 when you see the medical expense deductions. This is for accident and health insurance. Alright, here's our meals and lodging. Alright, so here's our employee fringe benefits. We're almost there. Let's see if we can find this table. And there's our group life insurance, which is cool. There's our education assistant plans, no additional costs, qualified 2.2-5, 2-5. As you can see, it goes pretty far. Oh, we may have passed it. We're going on to the next subject. Oh, well. Let's see. Here we go. There they are. 2.3. So again, this is a cool little list that tells you all these fringe benefits and how much. Like, look, there's a fringe benefit for adopting assistants. They can be exempt up to $13,810. That is so cool. I mean, there we go. Again, employee stock options beyond. This is beyond scope of this textbook, but basically you can have stock options in companies. Basically, employer provides cell phones, exempted primarily for business purposes. I mean, there's so much that employers can help you out with. So those are cool. Again, some of these we're going to come back to as the chapter goes, as they look at other items. But having the ebook alone, I will tell you, opens up a lot of stuff. And I would always suggest just to go ahead and read these chapters, because you actually do learn a lot from them. Alright, so back to the PowerPoint. So those are our fringe benefits employers can actually help out with. Next, let's say you won a prize. You won an award. Woo! Way to go, you! Yes! So these prizes and awards, they are taxable. They are part of gross income. They actually happen. The amount is going to be equal to the cash prize you won or fair market value. So don't think that you're going to just walk away with the lotto winnings and not pay taxes. You're going to have to. The exception is that employee awards of tangible personal property is up to $400 received for recognition of length and service or safety achievements are excludable, but up to $1,600 may be excluded if it's granted under a qualified plan award. Now, we'll give you an example on this in just a sec, but yeah, I mean, if the employer gives you an award and it's tangible, you may get to deduct a little bit. Cash, cash you have to include. But if it's like a gold watch or something like that for retirement, yeah. Now, game shows and reality TV show winners should always be aware that prizes and awards are taxable. This is the one thing that people don't realize, is that if you win a new car, you still have to pay taxes. Not only that, the taxes that we usually do, tax, title, license, but you also have to do it for if it's a state income tax or to the IRS. This can be a problem. I will tell you this. With California, if anybody has watched Price is Right, that is filmed in California, and most game shows are, you will have to pay the tax for the state right then and there. So as soon as you win it, you have to pay tax. So I will tell you this. The bad thing is, most likely, you cannot afford it, so you have to give up what you want in order to pay for the tax. It's a sucky thing, but that's what happens. So be aware if somehow you appear on game show or reality TV, you're going to have to pay tax on those prizes or awards that you have, not excludable. Okay. So here's our example. Joseph, an employee of Vespucius Sanctuaries, Vespucius, okay, not even gonna mess with that anymore, receives a clock for 20 years of service valued at $1,500, and the award is not considered a qualified plan award. How much is excluded from Joseph's gross income? Well, first off, if it was qualified plan award, it would all be excluded. But because it's not, we only get that $400. So $400 is excluded, and that $1,100 would have to be included in his gross income calculation. So sometimes that's good, sometimes that's bad. So we like to receive awards, just be prepared to probably pay taxes on them. Now, annuities. Annuities are a fun one. They have periodic payments. So, they usually pay for a certain amount of time. Mostly for us, in this chapter, we're going to deal with retirement plans. So, it is an annuity that basically the taxpayer buys in return for periodic payments for the remainder of their life. So, this can help out so you don't automatically spend everything in your IRA. You can choose to have it as an annuity. The taxable portion, though, of these periodic payments is calculated basically on mortality tables provided by the IRS. So the IRS actually assumes how long we're going to live when we start these annuities. So that could be good or bad. One good thing is that if you outlive their tables, you don't have to pay tax anymore. It's pretty cool. And it's also going to look at the annuity purchase price. So we typically going to use the simplified method on this. So individuals generally required to use the method to calculate the taxable amount from an annuity if the commence after 96. I think that's pretty much everybody now. So taxpayers must file in simplified method worksheet provided by the IRS. Alright, so let's go see what the worksheet looks like in our book. So, annuities. Here's our annuities. And then here's the worksheet. So again, here's the simplified method. So again, we enter the total amount of cost received this year, enter cost of the plan at the annuity starting date, age at annuity starting date. Here's the amount that we have to enter. The line divide 2 by 3, so forth and so on. There's a lot that goes into these. Again, cool thing with the IRS is that they kind of treat us as we don't know anything at times when they do these worksheets. So it's really, if you can read the instructions, you can follow along with these. Sometimes accountants that get their degrees kind of feel dumb, but then again, we relax to it. So we even have an example right here in your textbook with Joey at age 67 begins to receive his benefits under a joint and survivor annuity to be paid over the joint lives of himself and his wife Jody, who is 64. He receives his first payment of March of the current year. Joey contribute $38,000 to the annuity, and he has no distributions from the plan during the current year. The monthly payment to Joey is $1,700. Joey must use the simplified method. Okay, so here we go. Joey entered the total amount that he received. Total amount that he received is $1,700 times basically 10. Started in March. 3 months have already gone. So we had 10 months, or basically 2 months went, starting in March. So we had 10 months. So he received about $17,000. Enter the cost of the plan. Plan was $38,000. There's $38,000. Next, we basically enter in the combined age of annuity at start date. Well, combined annuity at start date, because it's a married, 67 plus 64. We're going to round up right about 131 through 140. So we must put 260. Okay. So those two, basically, we have 7 plus 4. That's 134. So yeah, right there. Okay. Now we divide lines 2 by line 3. So divide those two. We'll get $146.15. Alright. Multiply line 4 by the number of monthly payments this year. Again, we only had 10, so times that by 10. Enter the amount, if any, recovered tax-free in prior years. We just started, so we have none of that, and we're probably not going to have a lot tax-free. Okay? Subtract line 6 from line 2. Leaves us with just the $38,000. Enter the smaller of line 5 and line 7, which is $1,461.50. So our taxable amount this year is going to be the difference between line 1, the amount we received, and the $1,461. So basically, this is our exclusion from the annuity. So we actually have tax on $15,538.50. Yay! And it does warn you, do not enter anything less than 0. If it ever goes negative on the tax return, it goes 0. Okay? So, fun stuff there. Well, that's the simplified form. So whenever we see those, again, step by step, helps us out. Let's see, 214 through 215. See if they give another example. Nope, that's it. Cool, rock on. And this is getting into the general rule. So let's see. The general rule. Woo woo. So, before the simplified method, we had a lot more, not a good old down list of what to do. We had the general rule, which was used for most annuity calculations. Payments received are both taxable and non-taxable return on capital. The way we do this is first we have to calculate the exclusion ratio, which is basically the investment in the contract divided by annual payment times life expectancy. So basically from those charts that said we're going to live this long, this is how we figure it out. And then second, we take the amount excluded, so the exclusion ratio, and times it by the annual amount of annuity received. So again, this one brings in more of the math that we actually have to do. So let's see. Here's an example actually about this. So now notice that it also says pensions. Pensions tend to be the same as annuities. They are something that's paid throughout a life. Once we hit retirement, we get a certain amount. So they treated them about the same way. So cool pension plans, we get to figure out as we go. That's already calculated for us. Now, for our example, we have Den. Den has saved $750,000 in his retirement account and uses it to purchase an annuity. His annuity equals $4,800 per month, and the IRS tables show that right now he's expected to live 19 more years. Dang. Right below, man. You got 20 years left. Well, 19. Less than 20. How much is excludable from tax each year from Den's retirement? Assume that Den is required to use the general rule. Alright. So, with that being said, first thing we have to do is figure out the exclusion ratio. So again, we're using this formula right here. We take the investment divided by annual payments times life expectancy. So here, we know it's $750,000 was the contract that he went and purchased. We know he gets $4,800 per month. So we need to times that by 12 months. Again, since the expectancy of life is in years, we have to convert the payment to basically a year's worth. So once we take the 4,800 times 12, then times by 19 years, and divide that into 750,000, we get a ratio of 0.685, or basically 68.5%. That is the amount that is excluded from tax. So every year we take that ratio, we times it by how much he receives. So of course 4,800 times 12, we get a good old total of about 39,456 is excluded from taxes. So good amount right there. Now if we knew his age, if we knew Den's age, we can see which one's better with the simplified or the general. But because of the rule, if we look back here, anything after 96, so if the annuity payments commence after 96, they have to use the simplified method. No ifs, ands, or buts. But if it was before 96 and they're still getting paid, then we actually have to use this. Most likely nowadays, I think since 96 was what, getting close to let's see, over 20 years ago, we're getting probably more close to everybody just using simplified. But it's always good to know these rules just in case the odd thing happens and you get a client that has to use the general rule. So knowing both is always good, but mostly favored to the simplified method when it's annuities. Now, employees get annuities too. So employers may make periodic payments to retirement plans on behalf of their employees. These payments are non-taxable to the employee in the current year. Don't worry about it. Usually any payment to a retirement plan, just for the simplified it, is non-taxable until you withdraw it from the retirement plan. But they are also not considered part of the investment when calculating the exclusion ratio. So if Den actually had $500,000 that he saved and the other $250,000 was from the employer, we only do this ratio based on now the $500,000. So it will change completely. So less money that he actually gets to exclude. Okay? So we don't have to worry too much about that. So, next step, life insurance. So we love life insurance. This happens if we have a beneficiary that dies. So, and the beneficiary receives because of the death of the insured. Yay! So, not good moments, but hey, life insurance comes in. These are excluded from gross income. They're not going to tax someone that had a bad time and lost someone that they care for. So, proceeds paid to beneficiaries by reason of death of the insured, and beneficiaries has an insurable interest, are basically going to be excluded. But there's always a but, because it's the IRS. Interest on proceeds paid over several years is going to generally be taxable income. So, if you choose to receive this benefit in several years, be wary that you will have interest taxed on it. So that's a big note. So most people take all the money right then and there. They don't want to deal with that interest. Best thing is, either way, figure if it's going to go for several years after you receive the money and it's going to gain more interest, it's going to be taxable. No ifs, ands, or buts. So again, here's our insurance example. So with this, we have Karina. She ends up passing away on June 15th of 2018, leaving her husband Dan a $500,000 life insurance policies. The proceeds will be paid out to Dan $100,000 per year plus interest for 5 years. How much is taxable to Dan in the current year? Alright. So, in the current year, Dan receives the complete amount. Basically, $100,000 plus the $5,000 in interest. So again, calculations of interest, we don't have the complete thing, we just know the lifespan. If we know the complete thing, we can usually calculate interest. So how much is taxable? Well, with Dan, he must include the $5,000 of interest income and his gross income calculation. Again, this is going through multiple years, so 5 years. But that $100,000, non-taxable. So honestly, I'd rather take a hit on $5,000 than on $100,000. I don't know what, up to you, but I think that's reasonable right there. Again, this is mostly going on because that $5,000 is extra income. It's not part of this $500,000 life insurance policy. So because that's extra income, that's why it's taxable to Dan. So, I think the $100,000 is more than enough to actually cover taxes. Now, this one, I'm going to tell you, I'm going to butcher this word. VIATICal settlements are basically also known as accelerated death benefits, which I kind of like that better because I hear that one more than viatical. Accelerated death benefits are excludable from gross income, only in certain situations. Again, certain situations here because this is before we actually die. When it then becomes actual death, the beneficiary, again, life insurance comes in. So, in these certain situations, chronic or terminal ill taxpayers collect early payouts from their insurance company or basically sell/assigns policies to a viatical settlement provider. Terminally ill patients must have a certification, so they have to prove that they're terminally ill from a medical doctor stating that he or she has a reasonable expected to die within 24 months. This is how we can make it excludable. We have to have certification proof because the IRS demands it. Chronically ill must have that certification stating that they are unable to perform daily living activities unassisted anymore. So those two right there, if you can prove those, have that certification from your MD, you can have that actually excluded. And if you don't have those, IRS is going to make sure you get taxed on it, and if you didn't put it in there, oh, they're going to throw the penalties at you. So then you have to prove it, and it becomes a hassle. So notice this: if you do get a client that says they're terminally ill or chronically ill, make sure that you have that certification, okay? Because if you send this on by paper, put a copy of that certification in. If you send it electronically, usually software will have a check mark or something to actually put that document in. Life insurance policies transferred for value. If a policy is transferred for value, then all or part of its proceeds may be taxable to the recipient. Basically, we sell our insurance. Okay, so taxable amount is going to be proceeds from death of insured minus cash surrendered value at time of transfer plus premiums paid to the purchaser. So basically proceed this. If you sell the policy, whatever cash is surrendered, don't have to worry about because that's you buying that life insurance. But any premiums paid, you will actually have added taxable amount. So sometimes these are good deals, sometimes these are bad. So exception to this rule: if the policy is transferred for value to a partner of the insured, a partnership in which insured is a partner of a corporation in which the insured is an officer, then policy proceeds are non-taxable. So basically, if you sell this to your wife or your spouse, wife or husband, becomes non-taxable. If it's in a partnership, again, is a partner of a corporation in which insured is an officer. So if the CEO sells it and you're still a partner of that company, again, policy proceeds are non-taxable. Life insurance is a fun one. I will always tell you that's a fun one. So, but again, you don't see too much of it. It's a rare occurrence unless you're working for older demographic, but it does happen. So it's always good to have the knowledge of what's going on. So here's our example. Good examples always come. So Bianca decides to transfer a life insurance policy with a face value of $25,000 and cash surrendered value of $4,000 to Yvette as payment for services rendered. Yvette decides to pay premiums of $500 per year for a total of $1,500 in the ensuing 3 years. Bianca dies. So sad. Probably was a nice funeral. And Yvette collects the $25,000. How much must Yvette include in her gross income? And how would this answer differ if Yvette and Bianca were partners in the partnership? Well, first off, we have to basically take the face value of $25,000 minus the cash surrendered of $4,000. So 25 minus 4, we have about $21,000. And then plus the $1,500. So $1,500 looks like, wow, their solution looks like a little bit messed up. Because if we actually did the actual calculation, it should not be 19,500. Should be a little bit different. So they actually must include, delete, so 25,000 minus 4, that's 21,000, plus 1,500, that's 22,500 in income. Now, they got 19,500 basically by taking the 1,500 and subtracting it from 25,000. This happens, errors do happen. So, again, taxable amount equals proceeds from death of insurance minus cash surrendered, valued at time of transfer, plus the premiums paid by purchaser. So, again, they're going to include, if we use that formula, 22,500 in income. So yes, her paying the premiums kind of shoots herself in the foot of how much she has to include in income, but she actually receives the premiums back. So, yeah, again, life insurance policies are fun. Now, if Yvette and Bianca were partners in a partnership, the entire proceeds of $25,000 would be tax-free. No problems, no necessaries, they're just tax-free. Okay? No little fun little things. Okay, so interest income. This is the total interest, basically income. If it's greater than $1,500, must be reported on Schedule B of the 1040. Normally, as accountants, or especially tax accountants, if we receive anything that says interest on it, it don't matter what it is, put it on Schedule B. It's just a wise thing to do. Again, accountants are conservative, well, less risk takers, so we wouldn't actually put any amounts of interest. Again, basically the government's not going to really tax on anything that's less than $1,500 in the first place. And since they're already receiving the documents that said interest, it's just best to go ahead and put it on there. So interest is reported in the year received for cash basis for the taxpayers. Fair market value of gifts and services and taxpayer receipts for making long-term deposits or opening an account are considered taxable interest. So receiving that toaster, if you open a bank account, can be considered taxable interest. Normally we also have like having a home, you're doing owner's financing, that interest is also included in here. So anytime you actually do that, doing the owner finance, you need to include your interest. Government bonds, they have their own interest too that we also have to basically put into taxes. So there's Series EE bonds, which are purchased at discount and then redeemed. So interest is usually generally taxed. Year bonds are when the bonds are redeemed. So EEs, Don't have to worry until we actually redeem the bonds. Then we have to pay the interest. HH bonds are ones that are actually issued at face value, but they pay interest semi-annually, and interest is taxed each year. So the Treasury actually stopped issuing these, looks like in August of 2004, but there are also still outstanding HH bonds that are paying interest. They haven't redeemed all their HH bonds, so double H bonds. So be wary. Always watch out for double E and double H. Now, Series I bonds. These are purchased for face value, and the earnings are adjusted semi-annually for inflation. So again, these actually kind of shift in what they are. So interest is usually taxed each year or at maturity. So if it's redeemed in that year, we get interest. If it's taxed, we just basically pay interest each year. Government bonds are a good investment. They're actually super good because one, government can't defraud on bonds, so it's always good to invest into that. Dividend income. We have normally three kinds of dividends. One is the ordinary dividends. They are basically the most common ones. You'll see this usually comes from basically any corporation. They are a return of net income to shareholders. So we have that cash and we get taxed. Again, these are basically for corporations, the double taxation. Corporates get taxed on this, and then we get taxed on dividends. They again will show on the Schedule B, and when told dividend income is greater than $1,500, again, conservative accountants, most CPAs are going to put all dividends on there, just so if the IRS looks, we report it all, even if it doesn't reach that $1,500 threshold. Non-taxable distributions, though, are a return of original investment, not paid from corporate earnings and profits. These are not included in taxpayer income and reduces basis in stock. So this is our exclusion right here, non-taxable distributions. Cool thing, it's in their name, it's non-taxable. And a lot of times this is when the partner basically pulls out and the company pays the original investment back. Again, we don't see that much unless the corporation is doing real badly and then the shareholder wants to pull out. Okay? And then we have the capital gains distributions. So when their stock basically goes to zero basis, again, you get most of this in finance, but the basic thing is the company's stock is worthless. Any further distributions are known as capital gains distributions, and they get reported on basically page 1 of the Form 1040 or Schedule D. We tend to put these on Schedule D more often because they're capital gains. So you will see this probably on Schedule D, and we'll get into that also when we hit Schedule D with capital gains and basis. I think in, what was it, Chapter 8? Chapter 8 ends up having it, but we'll get into that as we go. So these are the current tax rates. Yay, current tax rates, woo! So qualified dividends are basically classified by corporations issuing dividends and brokerage firms holding stock investments. If they're not considered qualified, dividends are taxed at ordinary rates. Again, this one, we have to take the word from the corporations and the brokerage firms on qualified dividends. So here are the income levels. Qualified dividends and long-term capital gains rates are basically defined by these. If we married filing jointly, 0 to 77,200, 0%. From there up to 479,000, it's going to be 15%. And anything above 500K, you look at 20%. So that's our income level. Again, most people, if we're marrying filing jointly, it's probably going to be looking at the 15% on capital gains and qualified dividends. Single, again, figure mostly around the middle age. Now, if we're below that, again, 0. But you're probably going to figure about 15%. Again, if we hit over $425,000 as a single person, you get taxed at 20%. But if you're making that amount of money, you should be happy on that. Okay? I know it's a lot, but still, I mean, you made tons of money. Head of household, again, you're probably going to figure, well, probably, I mean, you're going to be in there at 15%. Again, greater than 452,000, even though it doesn't have the greater sign, is 20%. So, and then look at this. Additional 3.8% Medicare tax for high income taxpayers. So, on top of these 20%, if you're making over this amount, you're probably going to be looking at this. Probably more in the higher end of this one also. So, usually anything over like 150,000 tends to get Medicare tax on it. So, watch out and just know that there's always additional tax for if you're more of the higher, the rich kind of person. So, how do we report these? Well, payers send receipts known as Form 1099 INT for interest or 1099 DIV for dividends whenever they pay out anything larger than $10. So again, it's up to us to put it on there or not. Again, if all of them equal up to 1,500, then we have to report it. If they don't, then we don't. Again, the conservative route is just to report it, to show it, so in case the IRS goes, we have this document, we don't see it, you can just say, I mean, you don't have to answer that question of providing the document again, or basically amending your tax return. The IRS wants to be sticklers. So, tax exempt interest though, because some interest is considered tax exempt, again, like the non-taxable of the government bonds. These will appear on line 2A of 1099 DIV, I believe probably on INT, but they will show up on the 1099. Ordinary dividends reported in box 1A of 1099 DIV. Box 1B will report the qualified dividends. So qualified dividends are still included in ordinary dividends, so they actually basically get taken out. So whatever's left after qualified is taken out are basically 1B minus 1A, or 1A minus 1B. Is the ordinary dividends, and those are the taxable ones. Capital gains dividends are reported on box 2A and reported on Schedule D. It's just easier to report on Schedule D. So again, let's take an example. So, example's right here. Here's our example of the dividend one. So again, we have total ordinary dividends right here, 1,658, qualified, 1,658. So all my dividends are considered qualified dividends. And then of course we have total gains. Now we have a lot more items right here, which of course include the non-dividend distribution right here. We even have federal income tax withheld. Clients, our employees, our shareholders, they all can say that we want our federal income tax withheld if we're going to get taxed on it. So they actually do have that. We also have our expense that we get to deal with, and certain other items. Again, all of these, if we can get to it later on in this course, we will. But most likely, again, we just want you to know the basics. So again, 1A, 1B, 2A, 3. And again, just to see how the document is made. Okay, so again, here's the company, or basically the mutual fund, the payer's name, our recipients. So this one we can tell it's a married couple. The payer's TIN, taxpayer identification number, our EIN, and then of course the recipient's social security number are their TIN. Okay. 1099 interest. Again, we see the interest right here, 1,780. Again, you can see interest on U.S. savings bonds, an early withdrawal penalty if there is such a one, and of course all these others. Here's the tax exempt interest. Again, I don't know why they said 2A. I think they kind of got a little confused because 2A is capital gains distribution right here. So again, sometimes the book can make mistakes. So this is why I'm providing the actual documents and what they look like filled in. But tax exempt interest is right here. Little box 8. Okay. So this is our Schedule B. Now we're going to get into a lot of the schedules, but this one, as you can see with the watermark, was the draft at July 16, 2018. Right now this is actually still be the actual one. Again, since we're dealing with the book, we have to keep their drafts as they are. But basically, with this, part 1 deals with all the interest. So we would actually list the payer, put the interest amount, the excluded interest on Series EE and I U.S. savings bonds will go right here. If there's any taxable, non-taxable interest, we actually also put, we basically take it from our interest. Here we put in our ordinary dividends. Again, just the ordinary ones. Qualified basically do not appear because, again, it's a taxable thing. Most software will actually let you just put in all the amounts and just produce. In fact, Pro Series, if you decide to actually mess with that, again, we're not going into Pro Series, you can also look at that. And it will actually show you, hey, you can put in all the information from the 1099, INT, and DIV, and it will actually calculate and fill out this form for you, which is cool. And this last part 3 is only really for foreign accounts and trusts. So again, this is a total different item that we're not going to really get into too much, but most likely, if it's not related, this is to FBAR and to foreign items. Most likely you're not going to have a foreign item. If you do, this must have to be filled out, okay? Especially if it's 1,500 of interest or ordinary dividends. They're going to ask you to check off that nothing's been foreign. But if you had a foreign account and received a distribution form from anything in a foreign trust, if you check yes, there's additional forms. So we're not focused on that. I just want you to know where in Schedule B your interest and your dividends go. Alright, municipal bonds interest. So taxpayers can exclude interest on state and local government. Yay! Interest rates generally reflect after tax return that compensate higher income taxpayers. So after tax return for tax-free bonds calculate as follows. After tax return equals tax-free interest rate divided by 1 minus taxpayer tax rate, or basically 100% minus whatever their tax rate is. So of course, let's bring an example. So Gopal, something there, is in the 32% federal income tax bracket and invest in a Nashville city bond paying 6% interest basically. What taxable interest rate will yield the same after-tax return as the municipal bond? Well, like you can get into our formula, we have our tax-free interest rate, and then divide by basically 1 minus taxpayer's tax rate. So looking at this, we convert everything to decimals, helps out a little bit better, but 0.06 divided by 1.00 minus 0.32, which basically, if we divide those two, is 0.0882. Move your decimal to the right 2 places, and we get 8.82%. Taxable interest rate is not too tough. Okay. So gifts and inheritances. So done with interest, done with dividends. Now we move on to a different form of gifts. Okay. Prizes and gifts are two separate things. Prizes we won, gifts somebody actually gives to us. So inheritance are excluded from income. So don't worry about if you have any inheritance that comes to you. But if it's an estate, estates can and sometimes will incur taxes. Usually that's very high income estates. Low income does not. I think now it's somewhat over $1 million that the state has to have. So it's highly doubt. The government's trying to get rid of this tax. So keep an eye on it. It may actually go away. Gifts received are excluded from income. So a gift is basically defined by the courts as anything that's voluntary. So if I have a voluntary transfer of property without adequate, sorry, phone's going off right now, but without any adequate consideration, that's good. And it's also gifts in business settings. Now, those can be considered taxable income. So we will watch out for those. They usually are considered. That's a tricky subject. So mostly a voluntary transfer that's not in business settings are going to be excluded. If recipient renders services for the gift, amount is definitely taxable. So if I provide some kind of service and they voluntarily give me tickets to the Houston Texans game, then that's taxable to me. Okay, it's basically just you didn't do anything for it. They just decide out of the goodness of their heart to give you something, and it wasn't in the course of business. It wasn't in anything. Then it's excludable. There is actually a gift tax form that does have to be done, and this is just an information report so that shows who you gifted to. Scholarships received for fees, books, tuitions, course required supplies, or equipment are indeed excludable for income. But scholarships that are paid for room and board are compensation for required work. So if you're part of a work study, those are part of income. So you must include those. So as proper accountants, we look at scholarships and we have to ask, was this for supplies, books, tuition, so forth, or was this for room and board? This also means dorm rooms. That's room and board. Okay? So if the scholarship applied to any of that, it is considered taxable income to that student. So again, if you work for the scholarship, you had to do a work study, that's also required. So there's a lot of stuff that ends up being required, and a lot of these are hybrids. So we actually have to look into it to see if it's going to be excluded or not. So you can't just say scholarships are excluded. No, we have to look in and go, room and board is applied, work study have to pay. Same thing with gifts. If it was in business settings, it's taxable. If I worked for the gift, it's taxable. So no one can say they gifted you money after you mowed their yard. Does not work. It's still taxable. So alimony. Alimony is one that's going away. So yay, the TCJA that we have, that one that came out in 2017, is basically eliminating a lot of alimony. So alimony prior to December 31st was deductible to payer and taxable to payee. Now it's not. It's going away. It's gone. So then we basically eliminated the deduction for alimony. Conversely, the recipient need not to include alimony received as income. So from now on, alimony's gone. If you have anybody that's doing it before then, they have to require that. So because of this, and this is a sticky situation, alimony payments must meet 5 requirements as followed, if subject to divorce agreement after 1984, which should be pretty much everybody right now, but again, you will have those rare exceptions. So these 5 requirements, because you know I can probably quiz this or give you an exam on these. 1. Must be in cash and received by the ex-spouse. Must be made in connection with a written instrument, so the divorce agreement. Can't continue after death of the ex-spouse. Can't be designated as anything other than alimony. If it's designated as child support, that's not alimony. If it's designated to pay rent and it's not a rent instrument, it's not alimony. Parties must not be members of the same household. So 1, I can't really divorce my spouse and still live with them. That does not contribute alimony. So, and I don't know why you're still living with them. Some people are just that way, but you have to watch out for those. These are questions that accountants will ask about these. Now that it's being eliminated, we don't have to worry about alimony. Alimony is just what it is. Child support. Child support is not deductible to payer and not taxable to payee. One thing is, it's because it's directly for the child and not for the taxpayer. So, with that, we don't have to worry. It is an important factor because in determining which spouse gets the dependency exemption. Because basically with that's the agreement that says who has the child. If one's paying the support, then they can't claim the child because they're paying the support for the child to the ex-spouse. So the spouse that is the payee, or the payee, is going to have the dependency exemption. So they get that advantage. That's basically our written agreement that says that's going to happen. Qualified tuition programs. So the QTP, sometimes known as Section 529 tuition plans. These are nice ones. They allow taxpayers to meet the higher education expense by buying in-kind tuition credits or certifications, or basically contribute to an established savings type account. So with these, it's a good way to basically save up for your tuition for college. But here comes the TCJA. TCJA has now changed some stuff. Distributions are generally non-taxed if funds are used for higher education. So, with these savings plans, because you can get these if you have a child, you can start getting these plans, Section 529. But TCJA identifies tuition as an expense targeting books, supplies, equipment, and etc. Anything else that deals with ones. So, that do not appear to qualify. reasonable room and board costs qualify for this as tuition when it's according to one of these plans. Again, in a scholarship setting, you have to be taxable. Here, it's non-taxed in reasonable settings. You can't say you're renting out a mansion for a room and board. That's definitely not reasonable. But something reasonable, something close. And again, that is determined by the TCJA or the IRS, how they interpret that. And same thing with most accountants. As long as you can prove that it's reasonable for that area, you're good to go. TCJA also expanded this plan to include tuition for elementary and secondary education in public, private, or religious schools for up to $10,000. So if I have one of these plans and my child decides to go to a private school, we can basically have $10,000 of that income coming from the savings as non-taxable, which again is cool. It is, if not used for purposes outlined, or the taxpayer withdraws early. Again, there's a certain age limit for withdrawals. Again, about 55 and a half, 54 and a half, somewhere around there. Then the distribution are taxable plus a 10% penalty. So it has its advantages, then it has a whopping big disadvantage if you don't use it right. So you have to be careful of that, okay? Because that 10% penalty can hurt a lot. So again, with the QTP, annual contributions amounts do vary. Contribution is not deductible. High limits in most states, but subject to gift tax rules. Again, these you actually have to probably look at a financial planner. They're very great at these, and see how the state actually argues with it. But again, contributions are not deductible. We can't deduct paying into these. Don't try, don't do it. We may have a claim on the American Opportunity Credit or Lifetime Learning Credit. These we get to see in Chapter 7. These are known as deductions to AGI in the same year as distributions taken from a QTP. So we can actually have one of these extra credits. The only way that we can have these is as long as the distribution is not used for the same expenses for which an education credit will be claimed, and must also reduce qualified higher education expenses excluded from income from scholarships, veteran benefits, and so forth. So the GI Bill, you have to watch out. So again, this is a little tricky subject, but you just gotta watch out. So read the fine print of any contract to these QTPs, and you'll end up being okay with them. So again, with education savings accounts, so these Section 529 or anything other, these accounts do allow the taxpayer to meet those higher education needs. Now, to do these, annual contributions are not deductible. They are allowed until the beneficiary reaches 18. So if I'm doing Section 529, I gotta have up to 18 on certain of these. So these ESAs, you have to watch out. Limit is to $2,000 per year per child. You can't make it in the same year as a QTP contribution. So it's either or. So I mean, it's great that some people do like to make these education plans for their child, but you just have to watch out. Now, these do get phased out, and when we mean phased out, when you reach a certain limit, income, basically deductions are non-deductible, stuff like these, they lose their value. So again, the rich, according to the tax, gets taxed a lot more. because they don't get the benefits of these deductions or these non-deductibles. So when your AGI exceeds the 190,000, if you're married filing jointly, or 95 as single, it will phase out. No good, too bad. So distributions are tax-free. It only is if they're used for a higher education or private elementary / second education. Again, tuition, fees, books, supplies, equipment, room and board if at least a half-time student. So these gotta be half-time and you'll be good to go. Distributions assumed to be pro rata, which means from each category, return of capital versus earnings. So again, distributions, as long as they're for higher education, you're good. You may claim education credit in the same year as distribution, as long, again, as distribution is not used for the same expense. So just keep them separate, you're good to go. Now, if the distributions are greater than the qualified education expenses, part of that distribution will have to be taxable. So again, make sure your expenses are good, that they're paying them off, you're using the whole distributions for all the qualified education expense, and you'll be okay for not having that included in taxable income. So again, up to $4,000 above the line deduction for qualified tuition and related expenses phases out again at $130,000, or up to $2,000 deduction phases out at $65,000 for HOA, basically head of household, single, married filing jointly. So those we just have to watch out. Again, we're going to get back into these when we get later in the book. These will appear again. So these are currently expired, including herein, because have been previously extended multiple times. Government changes their mind a lot with taxes, so always watch out. Again, we're going to get back into this stuff when we hit chapter 7. Unemployment compensation. So these are basically, you're out of work, you're getting unemployment benefits from the state of Texas or federal. They get reported on a form 1099-G, and these payments are deductible on some state income tax returns, but they are actually included as income. You get unemployment, you have to pay your tax. Okay, so again, an example of this one is, here's the 1099-G, here's the $3,000 that comes from it, and we can, and I would suggest this, if you ever get unemployment tax, make sure that federal income tax is being withheld. This helps you out in the long run. Okay, and of course there's other boxes, but we're not going to get into those right now. Again, mostly we go with what's commonly done. Again, these you see not very often, but when we have a downturn like 2008, these came out more often because there's higher unemployment. But again, the state themselves, they're going to actually produce these and send them out to you. So always be wary if you have that. Social Security benefits. Again, part of Social Security benefits may be included in gross income. The maximum inclusion amount is 85%. So we have to calculate. Again, more calculations. So inclusions based on taxpayers' modified AGI. So the M AGI, which is basically our AGI, our adjustable gross income, plus tax exempt interest and other items. So in this amount, if our modified plus 50% times Social Security benefits is less than the base amount, then benefits are not includable. Again, we got plenty of software to actually use this with, which is great. So, but if this number exceeds the base amount, we must compute the tax portion. So again, a cool little thing. Right here, your book, we go to that page. So skip. Actually, let's go chapter contents. This is probably going to help us quicker. So right here, we've gone through all that. There's the Social Security. So again, right down here, we get this long list. And again, I would probably suggest to go ahead and go through this, see how it's calculated, and actually go through the example that they have with Nancy, and just go along with it. Again, it shows all the little extra items. The one, we have to know their filing status, and so forth and so on. So, real quick one is that calculating taxable amount of Social Security benefits, if it is this, and exceeds base amounts as follow. Base amount is $32,000, $25,000. Then we have to compute the tax. So maybe let's just go with it real quick. So with this, let me close this out so we can read the example. Nancy, a single taxpayer, receives $7,000 Social Security benefits. She has an adjusted gross income of $20,000, not including any Social Security income, and receives $10,000 of tax-exempt municipal bond interest. Nancy must include $3,500 of her Social Security benefits in income. The amount included in gross income is determined as follows. Alright, so first off, she has to beat out $25,000. What happens is that she has $20,000 right here. Her adjusted MAGI plus 50% of Social Security benefits. So 20, 10, so that's 30,000 plus 50% of that is definitely over the 25,000 base. So now we have to calculate here. So again, hit the plus sign. So first we enter the total amount of Social Security, which is $7,000. Enter 1/2 of 7,000, because that's the amount of benefit she received, is 3,500. Now we enter the total of taxable income items from 1040. So she received 20,000. We do not use the 10,000 because that was tax exempt. And that calculation for line 3. Line 4, we now enter 10,000 for taxable exempt. So in reality, she had 33,500. So enter all adjustments from AGI except for student loans. So these are all our deductions. She had none. So it's basically 33,500 versus 25,000 because that's our limit. So we know we're 8,500 over. So if it's greater than 0, we figure out the rest. So enter 9,000. Subtract the lines. If less, we put 0. So enter the smaller of line 9 or line 10. We enter in 8,500. Enter 1/2 of line 12, 4,250. Enter the smaller of line 2 or line 13. Well, line 13 was 3,500. This is a less for this. Line 2 was. Multiply line 11 by 85%, 0.85. If line 11 is 0, 0, well, it happens to be 0. No worries on that. Add line 14 and 15, 3,500. Multiply line 1 by 85%. So now we multiplied this one by 85% because we cannot go higher than that. And enter the smaller. Smaller was $3,500. So boom, that's the tax benefits that we are finding out are taxable. Woo! Lots of stuff. I like, again, the IRS doing this. Helps things out, so we don't have to worry too much. So, last little part, because I know this video is running long. Social Security income inclusion formulas. Okay, right here is basically we have the single HOA, surviving spouse, married, filing single. Again, under 25, we don't have to worry. 25,000 to 34,000, the lesser of the 50% of Social Security benefits, or 50% of MAGI plus 50 over 25,000. And then this one again, married and filing jointly, are over 34,000. We look at this formula right here. Okay, married and filing separately. Sorry, married and filing jointly, we have the same part. Again, we're going to look at the formulas right here. Now, thing that the PowerPoint doesn't get into, that we need to get into real quick, is of course the last little part that's part of your learning objectives. I don't know why the PowerPoints don't have it, but community property states, we actually have to focus on this. Now these, they basically don't distinguish between each other when it's separate. When you file separately in these following states and a community property state, they still consider 50-50. There's only certain things that end up actually can be separated. One is if basically you had property before y'all got married, that's considered still yours and you can file separate. Sometimes it's received as a gift or inheritance. You may want to file separate because of that, because that is, you can actually separate that out in a community property state. So as you can see, we have Arizona, California, Idaho, Louisiana, Nevada, New Mexico, us in Texas, Washington, Wisconsin. In Alaska, spouses may elect to treat income as community. So Alaska is one of those ones that you get the choice, but these states you do not. So with that, that's one thing you have to watch out for. Basically, no matter what, from there, property is the only thing you can actually separate out. If it's income, wages, stuff like that, usually they're going to end up coming to the same conclusion because they do 50% of everything. Okay, so watch on this. I would definitely just read this one up real quick, and of course we have an example right here. John and Marcia are married and live in Texas. John owns as his separate property stock in ACNT Corporation. During the year, John received dividends of $4,000. Assume that John and Marcia file separate. Each of them still have to report $2,000 of dividends. They can't separate that. On the other hand, if they lived in California, John could report the entire $4,000 of dividends on his tax return, and Marcia would not include. That is true in some, because right here we have the tax treatment of income from separate properties. Again, depends on there. In Idaho, Louisiana, Texas, and Wisconsin, it's still 50-50. California, you don't have to worry, even though it's community property. Again, another example right here is pretty good. It actually shows you Texas versus California versus common law states. So those are actually a good way just to go over to know what's happening with marrying, filing jointly in community property states. Okay, so that's it for chapter 2. Hopefully you learned some. Hopefully you stayed with me. If you paused and went back and forth, that's okay. That's why these are here. But I will be right back with you with the next exciting chapter of taxes. Bum, bum, bum.